All right. Well, thank you for having me. It's great to be a part of the Investor Inspiration. I know you guys have had a lot of speakers today. I hope you've had some great information. I know you have. I've joined in for a little bit of it as well. And you can always learn something from each and every speaker, so I hope to continue that as well today. As Reed was saying, my trading is based on probabilities and knowing not necessarily which trades are going to give me my winners and losers, but knowing that if I take a group of trades, that statistics are on my side and the probabilities of being profitable are on my side. So trading, a lot of people can make it glamorous. A lot of people like to show you the big winners and not show you the big losers, or they'll tell you that they have losers, but I'm here to tell you that we exploit edges in the market. And what I'm going to show you today is a way to exploit some of those edges. I'm not going to show you how you step in front of the market and every time you put a trade on, it's a top or a bottom. But I am going to show you how to spot market patterns which will signal reversals, as well as how to know, more importantly, when you're wrong so that your losers don't outweigh your winners. Okay, so there's a couple of components that I'll talk about in the presentation there. And like I said, I hope you can get a nugget or two. But before I get into that, let me go ahead and talk about, this is pretty much a disclosure that all of us have to abide by. The CFTC Rule 4.41 says that I will be showing some hypothetical examples. Most of my examples will be in the past. Hopefully, if I have time, I will jump over to some live charts from today as well and show you some of those. But anyway, the results are hypothetical or simulated, and we're not looking at live market data. And there's other disclaimers. The options trading and futures trading and stock trading in general can be risky if you don't know what you're doing. So make sure you seek out proper knowledge and trade according to your risk. So Reed kind of gave me an introduction. Let me just tell you that I've got, as far as my trading background, I kind of probably encompass a lot of people here because, number one, I'm not from New York City, and there's no offense against anybody in New York City, but I don't have to live in New York or Chicago in order to do this business, and that's one thing that's great about this business. I was born in a small town. I actually moved to one of the bigger cities in Virginia, not necessarily D.C., but I lived in Richmond for quite a few years while I was working in corporate America. And then I just always, my whole time in corporate America, I knew that there was something else out there, and I didn't really know what it was. I thought I wanted to be a professional real estate investor. I got the investor part right. I just chose now to do stocks, options, and futures contracts instead of the real estate. So I'm a paper asset trader versus a brick and mortar type investor. So each has its ability to grow your wealth. I just specialize and have developed a passion in the paper assets. So I love trading, I love the risk reward, and I love the education component of it. When I was in the IT, when I was in corporate America, I did get to train a lot of people. I was a database developer, but I was also a business analyst, and I got to take the things that the business needed and train the people, to use the data structures that we developed in order to make better business decisions. And unknowing at the time, that kind of molded my trading career because I take a real systematic approach to my trading, which I will go over with, and that translated into me wanting to run my own business and kind of help as many people get out of that corporate rut, or just, maybe you're not in a corporate rut. Maybe you own a small business, or you are retiring and just want to supplement your income, and that's, who I want to help, and that's why we run the trading room and created TradeTheSystem.com in order to help people who want to kind of be their own investor, so to speak. I start every presentation just about that I do with the next couple of slides, and for those of you who have seen me speak before or seen a presentation, I don't apologize for this being at the beginning of every presentation, whether I'm speaking on stocks, options, or futures, because I really think, and I truly believe, that in order for you to learn from someone, there's a couple of things you need to know. First, you've got to believe in what they're telling you, or at least have enough information to where you can validate what they tell you. And the next thing you got to know is, you know, why you want to do this. And when your why is big enough, the how becomes easy. And this is a big self-motivational type phrase. There's people who have taken this phrase and they've coined it in their own way. I picked it up from some of the self-help guys. So the reason that I included in my slides is because everybody talks about the nuts and bolts of trading, the MACD, the stochastic, you know, which moving averages to use and what indicators to use. Nobody talks about the mental side of, you know, what's got to drive you in order to be successful. Because the fact is, we're in a business, the trading business, where if you're not careful, fear and greed will absolutely, you can have the best technical knowledge in the world, and if you don't have that fear and greed, if you don't have that emotional state grounded, if you don't have a reason to protect your capital, if you don't have a reason to succeed, then all of that can go out of the window real quickly, because you can become an adrenaline junkie, so to speak. So I like to stay grounded, and I like this picture to keep me grounded. And what I do is, this is the reason whenever I'm thinking about, you know, if I have a losing trade and I'm not using my rules, you know, I'm not taking my time out, or I'm trying to follow up a losing trade and enforce my will upon the market, I think back for the reason that I'm trading. And the reason I'm trading is these guys right here. My wife, my oldest son, and my youngest son, who's hiding his face here in the middle picture. In order for me to support them, it's imperative for me to follow my rules. And when I find myself not wanting to follow my rules or not wanting to be patient and waiting for a move, I just think of why I trade. And it kind of gets me back down to earth and allows me to follow my plan pretty much to the T, because we live and die by our trading plans, okay? We're sitting here, and the thing that I'm going to harp on is, if you don't have a big enough reason to be peaceful, it's easy to not follow your plan. So the first thing, so this is why I trade, and I want you to look in your trading, and yeah, the money's great. The money is fine, a good reason to trade. You know, you want to make money. But if money's your only reason, there are a lot of professions out there that you can generate money and support your families from. Trading, there's definitely some frustration and some head scratching for anybody who's a professional trader to wonder, how in the world did we end up as a professional trader? You know, I mean, there's a whole lot easier ways, a lot simpler ways, a lot less stressful ways to make money if that's your only goal. So dig deep and figure out your why, and I think that will help you become a successful trader. We talked about, you know, identifying a couple of things. So I'm going to breeze through section 1, because I think that's real individual. I think you've got to develop your own plan. So I'm going to breeze through number 1, and then I'm going to spend time on number 2, and that's how to identify the potential tops and bottoms. This is the technical part of the presentation. And then we're going to get into my favorite trading situations. Now, I didn't say setups, I said situations, because the reason I say situations is because, and the previous speaker was actually hitting on this, not every time the MACD crosses is there a trade setup. So not every time a fib retracement happens is there a setup, okay? So I'm going to tell you the favorite situations that stack the odds in my favor. And I'm going to show you a tool that I use pretty much daily, or actually I use it probably every 5 minutes or whatever, to give me that edge and to predict the possible outcomes for the for the market. And again, it's not for the next particular trade that I take, but it's for the next group of trades under this situation. I should increase the account balance and not decrease my account balance. So I should have an equity run over the course of those setups as opposed to a drawdown, and that's what I'm going to talk about. So let's go ahead and get through number 1, plan your trade and trade your plan. I have a 3-step method. I'm just going to go over it real quick, because if you don't have a plan, I would love for you to adopt this one. If you have a plan, I just want to make sure that these 3 things are evident in your plan, and you are looking at each one of these. Number 1 is the trend, okay, and again, a lot of the speakers today probably have talked about some of these things, and that's why I'm not going to spend a whole lot of time on it. But the only thing that I'm going to add as far as the trend goes is you not only want to identify the direction, which everybody talks about, identify if you're late or early to the party. Are you expecting a change in the trend, or are you expecting a continuation? And I call that the phase of the trend. So if it, and I'm a big Dow trader. I love trading the Dow. I love trading crude oil. And what I'm going to say is, if you spot the Dow up 250 points on the day, well, that's a pretty easy direction to pick, right? If it's up 250, you're probably in an uptrend. But are you in a proper place to where you can really expect it to go up 30, 50, 70 more points for you in order for you to make money? And the answer is no, you're not in this current market environment. If you see 250 to 300 points on the Dow, you know, if you're up, I would caution you greatly on taking a long trade, because you're more likely to be able to identify a top or a bottom in that case. So don't, a little common sense, identify the trend technically, but if it's too far gone, then, you know, reserve the right to skip some trades based on your assumption of how much further the Dow can go. And then I'm going to show you one little tool that'll help you on that, that I use pretty much on a daily basis here in a second. The trigger. So we've identified the trend and the fact that we want to take a trade in a certain direction. So now this is where your setup comes from. Get a couple of technical things that line up, no more than, you know, 3 to 5, and then put those together to form your trigger, and only act in the market if that specific entry criteria is there. And then you just supervise the trade, and this is where most traders mess up. Okay, this is where a large portion of the traders mismanage their trades, because when I say supervise, I don't say trail the stop, I don't say, you know, take your profits, I don't say, you know, do whatever. It's supervising the trade, and a lot of times it's just doing that. It's being that mid-level manager who's just there watching, because if you get good at making the decisions, the only difference between you making a little bit of money and a lot of money is your ability to keep from monkeying with the trade, to keep from messing up a good decision. And so you sit back and you just watch the trade, manage the trade objectively. If you want some criteria, you know, after you get away from your entry price, then you can use some objective criteria like a parabolic SAR, or, you know, your fib retracements, and just make sure you give the trade room to breathe and let your employee or your the reason you got into the trade, let it work for you. Okay, don't be so quick to take profits. That's what I see more often than not in just about every person that is struggling, or a break-even trader. They just don't sit there and let the trades work long enough. Okay, so it doesn't matter if you like that 3-step plan. It's real simple. Yes, this is being recorded. It's real simple and it's real straightforward. So you identify the trend, get the trigger, and then supervise the trade. And you know, that's where we get the trade the system from, the TTS method, trend, trigger, and supervision. So the thing that I want to say is, it doesn't matter if you use ours, but just have a plan, and it's completely individual. You know, take components of my plan, take components of, you know, the previous 4 or 5 speakers' plans, and, you know, keep what you want, throw away what you don't need. Okay, and that's all I'm going to tell you. And if you want more guidance, we're obviously available. You know, you can contact me outside of this presentation, and I'll be more than happy to help you. But let's get to kind of the nuts and bolts of what I want to teach you today, and what I want you to take with you and use in tomorrow's trading session. Okay, we're coming off of a holiday weekend. It's very, very cold here in Virginia. We actually got 4.5 inches of snow. So the one good thing about these potential tops and bottoms is you can spot them early in the day, and then you can go play with your kids. Excuse me. I can go sleigh riding with my kids in the afternoons. So hopefully we'll get a top or a bottom, or a nice little top pattern that will give us some profits tomorrow morning. And I want you to be able to capitalize on that pretty quickly. You got 12 inches. Well, man, yeah. I told people in the trading room today, Gail, I said, you know, I'm a little crybaby because I got 4.5 inches and I didn't really want to come to work today. I didn't want to get in my truck and plow through the snow because 4.5 inches here in Southern Virginia is just like you know, 3 feet in Maine or something. It's something we doesn't take us a light dusting causes us to close schools and roads, you know, kind of get crazy. So I can't imagine what we would do with 12 inches. We would be shut down for a month probably. So you know, it's good to have a flexible business like I have. And like I said, let's get to how you can make the most of it. So if you did get 12 inches of snow, or maybe you're sitting in Florida or San Diego and it's going to be 70, 80 degrees tomorrow and you want to enjoy your afternoon, let's talk about how we can move to do that. Okay? And the first thing that I'm going to talk about is the structure of the market. So everybody can see the candlestick charts here, and excuse me, and you can see when the market's going down. Well, what I want to identify is the turning points in the market. What makes this candlestick pattern? Because right here you've got a lot of candlestick guys will tell you, oh, well, this is a bullish harami, right? It's taking up more than half the candle's body, and it's reversing. This is a key reversal pattern. Well, yes, it is. But what's so different between this and the fact that this is a bullish engulfing? Is that enough to separate these two trades? And I'm going to answer no, because the trades could be reversed. You could get the engulfing candle right here and the harami down here, and you could still have a nice little bottom. So the first thing we want to do is talk about the structure of the market. The market has to prove to you that it is going to make a directional change. Otherwise, you're probably going to go in the path of least resistance, which is in the direction of the trend. So the fact that the market, not just the fact that it closed green, but the fact that it continued and it got a stronger close above the swing points. Now, I don't want you to wait for that. I'm not a real big believer in let's let all the stars align before we take a trade. I'm a big believer in, okay, if we see this bottom here and we want to take the trade, we've got to respect structure. So if it breaks this low, then your hypothesis was wrong, okay? My 9-year-old's even studying the scientific method right now. So what he's looking at is trying to prove hypotheses. So I've been talking to him about, well, what do you think is going to happen? And this is where we get into trading. What do we think is going to happen if none of this was on the chart? Could this be a bottom? Well, I'm here to tell you that most markets, now if you're looking at an hourly chart, you may be a little different here. Daily charts, you can see more V bottoms, but most charts are not going to V bottom and top, okay? Now, we had some situations today, short term, we did have some V tops and V bottoms today, but most markets are going to give you a hint or a clue that they're getting ready to reverse. So let's talk about the difference between these two. And what we're going to have to bring and add some more to this. But the fact of the matter is, we never closed above the initiating candle here like we did right here. So we got the close above the initiating candle, and we even got some follow through. So the fact of the matter is, this is a better potential bottom, and you can see it continued on up. But look at the risk if you don't spot it early. Look at how much risk you have to take before you know you're wrong. You've got from the top of this candle all the way to the bottom of this tail to be proven wrong, okay? Right here, you have less risk, but you have a worse, probability of it working out. So let's take the best of both of these, and let's talk about how we avoid this trade and we take this trade, okay? So I just want you to know that pivots and previous price action is king. There's nothing better than price in my mind as an indicator, okay? Because markets respect structure. And the longer term the structure is present, the better the support and resistance is going to be. Now, I've got a 2-minute chart here on the Dow. And like I said, the Dow is one of my favorite markets to trade. And you can see what happens when you get this red and green kind of candle here. You mark the high and the low of the candle, and you project that all the way through. And as the market's coming into this level, it's going to make decisions, and we're going to evaluate those decisions. Just like the Fibonacci levels, this would be like your 50% level and your 618 level. It's an area that you're looking for prices to reverse or continue through. And you can see how important they are. When the market makes a decision to go through, it likes to run, and then it likes to come back up and test that level. And the first level is always the highest probability for rejection. Okay, now I'm getting a little bit away from my topic, so I just want you to know that
these places that we spot these price patterns that I'm going to tell you about, don't give up on them if the trade runs away from you, because they will respect it. And if it doesn't work, then you can use that information as well, because if you don't get the support right here that you're anticipating, then and the market starts running away from you, always look for that retest. That first retest of that support and resistance is very, very key. Okay? So we've talked about the market structure. Now let's put a definition of an oscillator in your hands. And a picture's worth 1,000 words. So these are oscillators. You've probably all heard of them. CCI average, MACD, not so much an oscillator, but a good indicator. Price channel, RSI, stochastic, all of those are available on just about any platform that you trade, any charting platform that you trade, okay? So what these do is they go from the oversold area to the overbought area and then back. Just, you know, they oscillate from overbought and oversold. Now the MACD I threw on here because it doesn't really fit, but it does go from bearish to bullish and then back to bearish again. And I can use that data because the momentum of the MACD will either be getting stronger or weaker, and that's what we're going to key on. We're not going to key on whether these indicators are overbought or oversold. What we're going to key on is how strong they are when price makes new highs or new lows, how strong or weak the indicators are. And I'm going to put that in perspective and introduce you to a term called divergence, okay? Divergence is, in my mind, and this is just my opinion, take it for what it's worth, but in my mind, divergence is one of the most powerful and the most hidden clues that the market gives you before it reverses or continues in the trend, okay? So what is divergence? Divergence is exactly, you know, what it sounds like. It shows a divergence between two different things, okay? So it means one's going one way and one's going the other. In this instance, we're looking at price and indicators, okay? So as the price is getting higher, are the indicators confirming and going higher, or is the indicator going to show you a divergence, okay? And these are instances where we want to know that's taking place in the market, because it's going to provide us that edge that we all seek on a daily basis, okay? So you can have bearish divergence where price is going higher and the indicator's not gaining strength, and then you can have bullish divergence where price is making new lows and the indicator starts making higher lows. So bullish divergence and bearish divergence, you can have, they have evil twins. They're evil twins of each other right there. So let's talk about how we spot that in the market. And I'm on a 1 minute chart. It doesn't really matter which time frame you're on, but you can, whatever time frame you're on, you can look for these price patterns. So you see the market's clearly in an uptrend right here. But what's the difference between this high, and this high? Well, step one is we've got to either be into new highs or be in a retracement at a predictive level where we can spot reversals, okay? So the second thing we've got to have, step two, is going to be the indicator. And you can see the whole time that price is going up, the indicators, it shows you, you know, getting stronger, getting stronger, getting stronger. And then all of a sudden, we've stopped getting in that overbought area, right? So from this move right here, this little peak right here, to this new high, look at the difference in the indicator. Really strong up to where it was, you know, pushing through new highs, and then all of a sudden we can barely get overbought here. So that's your heads up that this area, even though it looks like price is just running away from you, this area is a really good area to spot a top, okay? Why? Because we have divergence present. And let's talk about, you know, this particular area and what it has above the fact that we're sitting here with a divergence on the indicator. Under this scenario, the 100% ATR came in at 17,296. This top came in at about 17,350. Anytime you're at extended places, I talked about this right at the beginning of the chart here, right? I talked about knowing your levels and knowing which part of the trend you're at, okay? So in this instance, and in this screen capture I went back, but in this instance, the ATR was right here. So that means that in today's case, it would be like we would be up 200 points on the Dow, okay? So all through here, you're not at a phase of the trend where you think it's exhaustive. Okay, right in here, we know the trend can go higher because we're not at any extended ranges. Okay, so if you've got an ATR of 30 and you're trading at, up 35 points, you'll be above this white line. If you've got an ATR of, 250, if you see the Dow up 250, 260 points, you're looking for these patterns. Okay, otherwise, we're going to be looking for buying retracements because we know which way we're headed in the Dow. If you're up, 70 points and you're looking for a 200-point move, you're looking for retracement. So let's talk about this particular example, though. We're above the ATR, you get a new high, and then you get this relationship. So right here at the close of this red bar, you know that you can short right here and you can run a relatively tight stop, and you have the expectation that the market is going to roll over for you. Let's get into a couple more examples to make this a little clearer. So right here, you've got the market structure. You've got markets going up and down, and then right here, you've got a high put in place. You can see that this barely takes out the high, but it does make a new high with price. So from this high to this high, there is no divergence present. Okay, and this happens to be the stochastic on the Russell. And then when you make this new high, I call this like the blow-off top, if you will, you can see that the indicators are saying, no, don't believe this high, the market's really out of gas. Okay, so on this particular close, you know the divergence present, you take the short, your risk is defined from here to here, and in this case it's a 144 tick chart, so you've got less than a 2-point risk, and then you can anticipate the market coming back down, testing this structure, and then making a decision to go either lower or bounce back higher. But either way, you've got a profitable trade. And if you want a nice visual, here's the top, and here's the new high. Here's the high in the indicator, and here's the lower high. Okay, so I'm going to show you different time frames, different contracts, but look for this pattern in everything that I'm going to show you right here, and I'll sum it up with my favorite trading setups and situations right here. Okay, now I can't go into every single little detail of all these trade setups, but I will show you that price pattern is prevalent more often than not. Okay, so I'm going to be using an indicator that I developed that shows the divergence. There was nobody out there really. There was another company that had it, but they didn't determine the highs and lows like I wanted them to. So I actually paid a developer to develop this using my logic, and it shows when the pattern is present. Okay, and more importantly, it shows it when it's complete. Scalpers can use it to follow the trend. If you're on like a 144 tick chart, you'll get a lot of signals. So I'll tell you how to filter those out. And then longer term traders can use it, like if you're a spread trader for options, you can spot this on stocks as well as futures contracts. Okay, and the longer the chart time frame, so if you're using a daily chart, it's going to be more reliable, if you will, than if you're using like a 144 tick chart. However, I'm going to show you my favorite filters to make this trade setup profitable whichever way you use it. And the other thing that it does is it complements other tools and filters parabolic moves. So it keeps you from getting run over by that proverbial freight train or catching that proverbial falling knife. I know you've heard people say it's real dangerous to catch falling knives. Well, yes, it is. That's why we don't try to catch them. We try to let them hit the ground, and then we pick them up. So, and that way we can use them without getting ourselves hurt. So let's look at this. And one thing that I do want you to realize is you can fill your chart up with all this, and if you do that, it's very hard to make decisions. You've got, especially if you're day trading. Now, if you're looking at a daily chart and these bars only update once a day, you've got 24 hours, before the bar updates, and then that's a different story. You've got all the time in the world. But if you're trying to make a day trading decision or a short-term swing trading decision, you want to make that in the most efficient manner possible. So you can load up all the oscillators and try to spot and see which ones are giving you divergence, or you can just have these little dots show up, and I'll show you how to get those dots here in just a second. But here's an example of the Dow on a 144 tick chart, and this is the start of my favorite trading setups. So you've got to have three things present right here. Number one, we can't be at any extended ranges, and in this case, we weren't in any extended ranges. So we're going to assume the trend is going to continue to the downside, okay? So that's the first thing. You've got to be in the right phase of the trend. The next thing you do is you've got to be able to identify the trend, and in this case, I'm using moving averages. This is the, I believe this is the 38, and this is the 618 or the 62 period moving average. On a 144 tick chart, I just used them because they were fib numbers, and I like the fib numbers. These are triple exponential weighted moving averages, so don't try to recreate these. These are proprietary as well. I can discuss those at a later date. But basically, if it's real simple. If this channel is red, I'm looking for bearish divergence. And in this case, without having the histogram down here, take my word for it, when we made this equal high, the indicator was making a lower low, and that signaled a short trade. You got a secondary entry right here on this high when we made new highs, pulled back in the downtrend, then you got another trigger right there. So you had two opportunities in this downtrend to short the market. Now, if we look at crude oil, same situation. Red slingshot channel means we're in a downtrend. Bearish divergence right here, so this is a nice little top around this 56.90, 56.80 level. Ability for me to get short, run a stop above here, and then just trail that stop all the way down. Really nice move in this chart from 56.80 to 55.90. That is a $900 move per contract. So even if you're just a one contract trader, the ricochet here would produce $900 just on this one trade. Is that something you're going to get every day? In crude oil, probably. Crude oil is, I call it the, it's kind of soybeans on steroids, if you will. So it's a real volatile contract. I don't recommend it being your primary market or your first market to trade, but once you learn how to trade, spotting these tops and bottoms, these hidden clues can produce some big time profit in a very little amount of time. So let's talk about gold and look at the CCI on gold. You can see right here, we're in a downtrend in gold. We've got a little rally, and we're looking for bearish divergence. Right here at the 1200 level, you can see the bearish divergence that took place from this high right here to this little hump right here on the CCI. Marks a place to short. You can take your profits. You may get stopped out depending on your trail stop, but then it goes lower all the way down here to 1194. That's good for from 1200 to 1194 is $600 per contract. And again, that's using, you can use a bunch of different oscillators. The CCI here is one I just showcased. The Dow on a 5-minute chart, you've got a downtrend in place, so we know we're looking for bearish indications. We get the indicators right here in the overbought area. Lower high, you get a divergence signal. Shorting the Dow here. This one's actually only good for 60 to about 20. So this is only good for about 100, 150 bucks, but still, that's in a real short amount of time right at the end of the day, the last 15, 20 minutes of the trading day. Really nice signal there to scalp off extra couple of $100 there. What else do we have? Key levels. I talked about the ATR range. So that's a filter that I put on looking for these divergence trades. So what makes this the better trade than right here? You can see this one failed. Not the fact that it failed. And look right here, this is what I talked about earlier. You have this support that failed, so even if you took a long trade right here expecting the momentum of the market to be good, watch when you're wrong, watch for a retest back here because this market structure is going to be supported. This happens to be the 100-period ATR or the 100% of the ATR, and this is 120% of the ATR. So I knew we were at an extended range. I waited for a bearish signal, and instead of just shorting here because we were, kind of up on the day and up 290 points, I wanted to wait, get me a signal, and that way I can control my risk because I know if I short here, I can control my risk on this top right here and make a really nice high probability trade back down to some less extended areas. So that's some other things that you can consider is the ATR range as well as the moving averages, which direction they're in. And if you use other things like linear regression channels or Fibonacci levels and extensions, that's fine too. This just complements those areas. So the one thing that I want to do here is just kind of make sure you understand this is not any magic bullet, and it's going to, it does simplify your life, but more importantly, I want you to understand what the charts are telling you, because what we see here, This trade in hindsight looks great. It's bullish divergence and the market takes off. But unless crude oil is in an extended level right here at $60.50 or you have prior support, this is going to be a trade that's going to trigger and you're just going to watch it go up. But why? Because this right here is the better entry in my view. You have, you don't have to wait for everything to align, but you don't want to catch a falling knife. If you try to buy the crude oil right here at $60.50, yeah, you look like a genius in hindsight, but we're not trying to catch falling knives. We want the trades that are, more than likely going to give us the move. And yeah, we may miss a couple of $100 here, but we're going to not, we're not going to get cut so much or run over by those trains if we wait for the proper signals. Same thing right here. When the bearish divergence is present, and the reason I know it's present is because of these dots and then the trigger dot here. I know we got a lower close. When it's bearish, we need to make sure that we're in a downtrend. And the fact of the matter is we were in a downtrend, but when we took out, the previous speaker talked about an impulse move. This is an impulse move right here. And when you take out that previous structure, your downtrend is no longer valid. So we're going to ignore this signal. And so out of these three signals, only one of them is actually valid to take, okay? And I can explain those rules in depth, at a later date if you're interested. But what I want to, I want you to look at next, the next trading day, and let me go back to the previous slide. The next, tomorrow morning, what I want you to look at is I want you to try to spot these areas where in whatever oscillator you want to use, the CCI, RSI, on balance volume is a decent one. There's 1,000 different indicators that you can use, but I want you to spot the divergences. And if you have trouble doing that, then I do have this indicator that I would like to offer you. I'm almost, let's see here. I've got a couple of minutes here, so I can jump to some real-life charts. But let me make you this offer first, and then I will jump and do a quick Q&A. So the thing that I want to offer you today is the ability to get this indicator. Now, it is available for limited platforms, and it is. I don't have every single indicator coded. I do have the CCI, the RSI, the price channel, the MACD, and the stochastic coded for TradeStation, Ninja, and Thinkorswim. Already available. If you make the purchase today, you'll get an email where you can download them immediately. You can install the files and have them up and running before tomorrow. Now, I normally sell these for about $97 a piece. So we used to actually, 97 is the discounted offer for members, but that normally totals $485. Today, I'm going to give them for $197 to the first 30 people. You can log in, put www.tradethesystem.com/ricochet in your browser. It'll bring you to an order page. Now, you're also going to get some training sessions that will be emailed to you that you can watch in the recordings. And this Thursday from 9:30 to 11:30, I'm actually doing a training session on the ricochet and divergence, and you can get that training session for free included in your price of $197, okay? So that's not $197 for the course and $197 for the indicator. You get all 5 indicators for whichever platform you want and the 2-hour training for $197. There's your link again for that, and that is available only for the first 30 people. We do offer no questions asked, satisfaction guaranteed. www.tradethesystem.com/ricochet, and I'm not going to bore you with all of the sales pitch. I've told you what I'm offering, and you can choose to take me up on it or not, but either way I'm going to hang around for a couple of minutes and answer questions. Okay, the first question is, will that session be recorded Thursday? Yes, it will be, and it will be posted to your resource page, so you'll have the on-demand sessions, some previous sessions that I did to learn from, as well as that 2-hour session will all be available to you. Are they different than the ones already on the platform? Monica, I'm not sure what's on the platform already. There are no divergence indicators that I know of that are on the platform. So I'm not selling the oscillator. I'm not selling your CC or the R or anything like that. The indicator is the little areas that show you where the divergence of those indicators are, so you don't have to fill your chart up with all the oscillators. So I'm not showing you I'm not giving you the CCI. You've already got CCI, RSI, price channel, and everything like that. I'm going to show you my indicators where those actually, take place, where the divergence actually takes place. So let's go here, and I do want to hit a couple of questions. Somebody asked if it worked. If it worked on stocks as well. And the answer is yes, it does work on stocks as long as they have some volume. And this is the workspace that I use and I like. And then you can see right here on the 1 minute chart for today's action in the Dow, we got a couple of little sells into the close here. And then you can see that we had a relatively choppy day. We had an uptrend, and we almost had a nice little signal here. So today we actually had some support here, and you can see how long the 18,000 level ran as support. And you would have eventually gotten paid on this, and then the market would have rolled back over. But these are live charts, so they're not cherry-picked, and you can use them. You can see that the 5 minute area, it actually showed you a resistance area right here at 18,020, gave you an area that if you had a confirmation on your smaller time frame chart, you could have picked off about 150, 200 bucks. Not too bad of a trade. Let me see, there was other questions, I believe, out there. Could you please indicate the trend on oil? So crude oil is, kind of a wishy-washy market right now. Right now, there's a mixed bag, and I wouldn't try to trade crude in a swing direction right now. I would just take advantage of the intraday volatility. Like if you see the market topping out right here, I would try to catch pieces of this. So the ricochet is not really for trend definition. It's more for spotting, like a top or a bottom. So it's not really designed for a trend definition. But overall, the crude oil has been on a downtrend, obviously, but we're in that retracement phase, and it's trying to determine whether it wants to, put a deeper retracement in. And then currently, I think personally, in my newsletter, I'm actually recommending crude to the long side until we get to about that $62 price level.